as we speak, the equity markets seem to be going downhill all the way, and even among them, it is the mid-cap and the small-cap segment that has taken most of the beating. So we thought it would be interesting to talk to the expert himself. What should investors do in the current market scenario, and what is his investment philosophy during testing times like these? So today we have with us Mr. Ankit Jain, Equity Fund Manager at Mirae Asset Mutual Fund. Ankit is currently managing Mirae Assets Midcap Fund and co-managing its Emerging Blue Chip Fund and Great Consumer Fund. Welcome Ankit, and thank you for taking out time for having this interaction.
Thank you for having me.
If we look at the headline numbers, then indices like BSE Midcap 150 and BSE Small Cap 250 have collapsed by around 15 to 20% if we look at it on a year-to-date basis. But if one goes deeper, we find that this segment is really bleeding because nearly one-third of these stocks have collapsed by say 25 to 65%. So do you think this is an opportune time for the investors to increase their allocation to mid-cap and small-cap stocks, or should they be taking shelter in a more stable and sustainable large-cap universe?
So you go back to the history, typically mid and small caps are obviously tend to be more volatile than large cap. So whenever top-down scenario is a bit volatile, typically mid and small cap has to underperform the large cap, because obviously from the risk adjusted return point of view, I mean large caps are relatively better placed during the volatile times. Yeah. But having said that, you look into, let's say, last 5-year, 10-year CAGR, or even last 3-year CAGR, even after this sort of a decline, 3-year CAGR return, let's say for Nifty mid-cap 100 or maybe 150, whichever index you want to compare versus large cap, they have outperformed. Even after this decline, last 3-year return for mid-cap is at around 17% versus large cap at around 13%. You look into 5-year or 10-year, typically in any long-term time horizon, mid-cap and small cap typically tend to give higher absolute return versus the large cap. We remain fairly comfortable if someone is having a long-term sort of a time frame, why mid and small cap can't continue to outperform large cap, at least from 5-year time horizon. And the key thing has been that typically the earnings growth for mid and small cap, sheerly because of their lower base in terms of the business, as well as, let's say, more sort of an opportunities, typically mid and small cap earnings to tend to outperform large cap. So to that extent, obviously your returns over a longer time horizon has to be higher than the large cap index. Having said that, if one is really looking from a near-term standpoint, valuations at this point of a time versus large cap are still not that attractive purely for the mid cap. I mean, if you look into 1 year forward, we are at around 18 odd times for Nifty mid cap 100 versus you look into, let's say, large cap, 1 year forward, we are at around 16 and a half times. So purely on that valuation, let's say mid cap as a bucket might still be trading at a premium, versus historical, they might be trading at, let's say, similar sort of evaluation. So really, I mean, if we look into from 6 month to 1 year point of view, maybe large cap might be relatively a better place because of relatively better valuations versus mid cap, as well as their ability to withstand volatility and still delivering on to the earnings growth is basically better. Or let me put it in other way, that predictability of earning growth might be slightly higher there. But as I said to you, that 3-5 year standpoint, we remain fairly comfortable that mid-cap should continue to outperform large cap. Yeah.
So coming to the fund that you directly manage, that is Mirae Asset Midcap Fund, it is about to complete 3 years soon, and despite being a relatively new entrant into this field, it has started off quite well, beating both the category and the benchmark. And even in the declining markets that we are into right now, the fund has managed the downside better vis-a-vis many of its peers. So can you elaborate your approach to midcap stock selection, and how do you manage to avoid major accidents in this segment, which is, quite often considered more important than identifying multi-baggers?
3 key points, let's say, while you're trying to evaluate any businesses. One is characteristic of the business itself, business selection. Second is management evaluation, and third is obviously the valuation. So these 3 key points is typically we do look into while evaluating for any particular business. When it comes to business selection, the key question we keep on asking ourselves is that what is the addressable market for that particular business, and that will give you the comfort that how long business can sustainably keep on growing, or let's say what is the longevity of the growth. India being a growth market, typically because of so many things. I mean, demographics and low penetration across most of the categories, rising per capita and all. So ideally, we always want to invest into growth-oriented businesses, which at least can grow in line with nominal GDP growth rate of the country or even higher than that. So that is one key aspect when it comes to business selection. And obviously, that growth has to come at a certain sort of a ROI threshold, because obviously that remains a key benchmark. So typically we do go by pre-tax ROI more than 15%. When it comes to business selection, obviously there has to be large market opportunity, and that has to come at some sort of a sustainable business mode or maybe competitive advantage, which pretty much getting reflected in your ROI. So typically we work with pre-tax ROI more than 15 odd percent. So try to invest into growth oriented businesses, but up to a reasonable price. GAP strategy is typically what we do tend to follow. Second comes to obviously the management evaluation. There are qualitative as well as quantitative factors to really try to evaluate the management competency, thought leadership, their historical, their ability to really being able to increase addressable market or keep on gaining market share. So some of these aspects. Apart from that, obviously we do give a lot of emphasis onto the primary research. Try go and meet with the different stakeholders. I mean, who are in a way day-to-day interacting with the management and all, try to get more feedback out there. That remains again one of the key part of our sort of an evaluation. Then apart from that, you really have to look into the softer aspects. Then let's say auditors, related party transactions, corporate governance framework. So all of this falls under the management evaluation bucket. Third key aspect is on the valuation side. Obviously, price which you are paying to buy that business has to be lower than the value you are ascribing to that particular business. When it comes to the ascribing value, typically we do follow DCF model, discounted cash flow approach, because when we are owning a business, we do typically tend to look from 3-5 year and even higher point of view, rather than just bogged down by the fact that near-term earnings might be bit sort of distorted because of so many factors. So when it comes to DCF approach, typically our assumption, long-term assumption has to be keep in mind, and then try to arrive into the value for that particular business. And if your value is higher than the underlying price, then obviously we do so this is the typical approach when it comes to the stock selection. Then obviously portfolio construction becomes another important aspect. That so on your point also, that to avoid mistakes, that again might be one of the key aspects, that we do try to make portfolio as diversified as possible. So if you really try to look into the portfolio, we do not give very high active weight at the sectoral level, because typically sectors do follow cycles, and it becomes very difficult really at times to really take a particular sector call. So it is always better to go with the sectoral weightage nearby, let's say what the underlying benchmark sectoral weightage has been. Obviously there might be some bit deviation here and there, but it should not be the case that there is a very high sector weight into the benchmark and then you are not owning anything into that. So typically there has to be a sectoral weight which is giving enough diversification to your portfolio, which can also withstand some of the mistakes which you might make during this entire process. And then at the same time, you do tend to give very high active weight to the specific stock within that sector. Yeah, exactly. So that very high active weight, irrespective of the benchmark, very high active weight on particular stocks, that also reflects into the conviction you are having onto that particular name. And that is how you do really go about and try and build in your portfolio. So overall portfolio has to be diversified, at the same time should reflect your conviction in the form of higher concentration as well. So that you do try to balance it out, and approach has always been that try to perform across all the cycles. So that is why the philosophy also has been that not to go overboard on any particular theme or any particular sector as such, and try to diversify and then try to pick out the best out of whatever based on the bottom-up stock picking. when it comes to the portfolio, it has to be a well balanced of growth as well as, let's say, value stocks as well. Though our first priority always remains to own growth oriented businesses. But when I said that this is up to a price, right? And typically in markets and all, we do see that given flows and all that, it might also at times becomes, let's say, buy at any price and all that. But if you really try to scan it through our portfolios, it is a pretty actively managed portfolio and has to follow the underlying process as such. Good mix of growth and value also gives you some sort of protection, let's say, when markets are volatile. So typically you look into, let's say, portfolio 65-70% of the portfolio might be, let's say, core growth oriented portfolio, where, let's say, companies might be performing in quartile 1 in terms of growth among the peers and pretty good ROI and all that sort of filters. At the same time, we also having 20-25% of the portfolio which is more, let's say, value in nature, where, let's say, might come some of the PSU names, some of the defense PSUs, or maybe some of these sort of, or let's say PSU utility name, industrials, some of that bucket, which do also helps you protect really downside. And second, at the same time, these companies on its own do also have merit to own, right? Because in most of the cases they might be trading at, let's say, less than price to book, lower than their replacement value. So to that extent, good mix of growth as well as the value bucket also do help in protecting downside during volatile times.
So when it comes to investing in new age companies, Mirae has taken quite a different call unlike many other AMCs. So can you explain what was the investment rationale for taking exposure to these names? And also in the hindsight, has your view changed now? Because the way things stand today, almost all of them are down by more than 50% as compared to the listing price. And some of them are also facing corporate governance issues with the regulator.
Yeah. No, as a house, I mean, obviously we have taken certain exposure to those newest businesses. Again, going by our business management and valuation sort of a philosophy and criteria to evaluate. Really, this particular space is also becomes a bit difficult for us as a, let's say, public market investors, because typically our anticipation in, let's say, DCF valuation and all, typically we tend to value profitable companies till now. Definitely some of these has been a new element while really trying to evaluate. Having said that, most of these businesses, if you really look into from the growth standpoint, no doubt at all. I mean, pretty much longer term growth opportunity given the sort of a demographics, things are changing, more penetration across most of their services, products and all. So that is one side of it. So business wise, obviously growth runway pretty much remains. Second, management, it depends that how typically it do come out. I mean, really you have to give more sort of a time. It cannot be like suddenly the expectation when these companies coming into the public market as such to suddenly turn profitable from the day one. While, let's say, they might have continued losses historically and all, some of these companies haven't done well, also on account of global meltdown into some of these names as a result of interest rate increase. Because when you do really try to value these companies on DCF approach, there is a very high sensitivity to your discount rate which you are following, because obviously a large amount of their value do come from later part of the years or maybe the terminal value, because companies as of now is not profitable. To set out expectations that post listing suddenly within a quarter these companies will start making profits, obviously that was never an assumption. In certain cases, yeah, some corporate governance issues and all might have been, so accordingly we have taken call. And in certain cases we might have, let's say, companies might have done some sort of acquisitions and all that, which might elongate their path to profitability. We might have taken certain calls and might have exited also, or might have trimmed down. But really, idea always has been to look into these businesses from very longer term standpoint. And at the same time, obviously, in the hindsight, you can say that you might have to do, let's say, better sensitivity to your back, different scenarios and all that, which could have been the case. But having said that, I mean, we are fine owning some of these businesses from a very, very long term standpoint.
So would you like to increase exposure to these names, or would you just stay constant to where the exposures are?
So again, have to go case by case rather than just bogged down by the fact that some of your bets might not have turned out well as things are looking at this point of a time. That doesn't mean that you don't invest into this space. And more so, if you look into after that, also one of the recent IPO, we have invested into that. So again, it has to go by very business to business basis. And then again, you have to get absolute comfort onto the management, because again, that becomes one of the key criteria. On the valuation side, I agree, given the very high sensitivity attached to your discounting rate, sometimes these sort of volatilities might exist. But having said that, we will continue to evaluate on case-to-case basis, and then we'll take a call accordingly. Yeah.
So you have started off your career as a fund manager with Mirae around 5 years back. So please explain more about your professional journey and any key learnings that you have taken on the way and that have shaped your orientation as a fund manager.
Sure. No, so I've been in this industry now for 10 years. Initial part of my career, 3 years, I have spent in a sell side broking firm. And last 7 years, I have been with Mirae. Now will complete 7 years, I think next month itself. Initial 1.5 years, I was working as an analyst, tracking entire consumption sector and then auto sector, some of that. And then obviously 1.5 years into that journey, I got an opportunity to manage, start my career as a fund manager into the Great Consumer Fund, which is a thematic fund investing into the consumption space. And obviously, I am having that sort of a background of tracking those businesses as an analyst. That has really helped me a lot while starting as a fund manager into that product. And then obviously on the way, certain offshore mandates, which are again following midcap strategy, also come my way. Me along with Nilesh, we have started managing those mandates. And then obviously this midcap, domestic midcap happened 3 years back. That journey also has been very, very interesting. Though it looks like obviously it is a very short, brief history of 3 years, but the amount of cycles we have seen in this 3 years, right from extreme pessimism during the COVID, and then extreme optimism, and all geopolitical. In the hindsight, it looks like it has been a great learning opportunity that in such a short span of time, you have been able to see so many market cycles as such. It is something very, very, good from the learning standpoint. Domestic midcap now almost will complete, 3 years as of now. So yeah, it has been a good and very, very satisfactory journey till now. And obviously the sort of a platform, you have got being with Mirae, and obviously the entire support system in terms of research team and all, that has been something very, very commendable throughout this journey. Yeah.
So that is all we have for today, and we hope our viewers benefit out of your insights that you have shared in this interaction.
Yeah, thanks a lot for this opportunity, and looking forward for future interactions as well. Thank you.